In financial modeling, high beta is routinely treated as high danger. A volatile strategy is called risky. A smooth return stream is called safe. But volatility and ruin probability are not the same quantity. Volatility measures how widely returns oscillate around their expected value. Ruin probability measures whether the portfolio trajectory reaches zero capital. These are structurally different objects. Confusing them leads to portfolios that look controlled but are approaching collapse. In a stochastic model, volatility is symmetric dispersion around the drift. A large upward move and an equivalent downward move contribute identically to measured volatility. The model does not distinguish direction. It does not register whether losses accumulate toward an absorbing threshold. Volatility is a second moment. It measures spread. It carries no information about how far the trajectory is from the absorbing state. Ruin in a stochastic model is defined as the path reaching zero capital or a margin threshold. This is an absorbing boundary. Once the trajectory crosses it, the model terminates. There is no recovery from that state. This structure is asymmetric. Only downward crossings of the boundary matter. Large upward moves are irrelevant to ruin probability. Only the distance between the current capital level and the absorbing threshold determines exposure. A high-volatility strategy can carry low ruin probability. If the capital buffer is large relative to the absorbing threshold, the trajectory oscillates widely but remains far from ruin. The returns are noisy, the variance is large, but each oscillation stays well above the level at which the model terminates. Distance from the absorbing boundary is what determines structural safety, not the width of the return distribution. A smooth, low-volatility strategy can carry high ruin probability. This is precisely what occurred in Madoff-style structures. Returns appeared stable and controlled. Volatility was near zero, but capital was steadily being consumed by an adverse drift masked by fraudulent reporting. The trajectory was moving toward the absorbing boundary without visible warning. Apparent calm in return volatility was not structural safety. Stochastic models that optimize for volatility reduction do not minimize ruin probability. They are solving a different objective. Volatility measures spread around a mean. Ruin probability measures proximity to an absorbing boundary under drift. These are not equivalent. A minimum variance portfolio can be on a trajectory toward insolvency. To manage ruin, the model must track distance from the absorbing threshold. Volatility alone is an insufficient and misleading proxy for that distance.